Hey everybody, welcome to the morning market briefing. It's Tuesday, right? Yeah, Tuesday, May 17th, 2022. How's everybody doing?
So good.
So good. We're ready to go. Let's jump in with the market. Tom, hearing from Bullard, I guess right now. Is he talking already? We can't really find him talking, but is he
Yes.
talking?
So he's talking at the energy infrastructure conference. There's a number of Fed speakers there today. I think it's him, then it's Harker, then Powell, and then a couple of the B team Fed members talking this afternoon. So I'm just getting live updates on Twitter is what he said. He's basically saying that tighter Fed policy is already baked into markets and they don't necessarily need to get tighter, which is a little bit of a shift from his normal speaking, which is essentially he's the hawk, he's the big hawk. He wants to say that the Fed is going to get more and more aggressive. A couple other things that I've seen come through is that he said that the biggest risks to the U.S. economy are not from within or inflation, that they're more based on, China's handling of COVID. If they can't find an exit strategy for this year of COVID, that's going to cause inflation to rise here versus, anything that's actually happening on the demand side. It's really more a function of outside forces. He said that Ukraine, in his opinion, has been contained from an economic standpoint, and not to expect the European Union to go into a recession, which I don't exactly know how that's going to happen. That seems like I don't know exactly where he's getting that information, but even if the economic impact was contained, I think there's a lot of factors that are pushing the European Union into a recession. And I think that if we're going to have a hard landing, they're going to be a plane flying full speed in the side of a mountain at the rate we're going. So
dark imagery to start the morning.
So I don't know what he's looking at that would indicate that. I think Europe's in a much worse position than we are, even though things continue to be relatively bleak. Most recent tweet: U.S. labor market is super strong. We continue trend growth for the U.S. as a base case outlook for the next 18 months at least. And the most pressing issue is for the Fed to contain inflation, but that China's going to have the biggest impact.
Tom, what's trend growth then? That's a great question because, the last data point we had was negative 1.4%.
Yeah, that's a great point. Now, this quote is continued above trend growth for the U.S. is the base case outlook for the next 18 months at least. That's the direct quote. So I'm assuming economic. It's tough to say. We're just getting tweets here. It's not the best way to get a read through on what Bullard's saying, but we're getting it a little bit.
And I think it gets to. It's very interesting comments that you said, because from what I hear, this is an extremely dovish perspective based on where we usually see Bullard come in, or at least what we've seen from him for the last 9 months. This is extremely dovish and does mark a significant change. And I think the Fed has become emboldened by a marginally lower CPI print last time around. And I think they expect that this disinflation is going to continue. I think we're going into dangerous territory if that is the view, because I think if the Fed does take its foot off the brake at this point in time, you could see, we're going to talk about some retail sales data later today that I think is explicitly inflationary, and I think continuing to be so. And I think if the Fed does not see that, I think that is a little bit dangerous. But they're probably seeing the breaks that we're seeing in the mortgage market. They're probably seeing the breaks that we're seeing in high yield. They're seeing the breaks that we're seeing in crypto. But I think a very significant comments that we're seeing from Bullard this morning in terms of a little bit more of a dovish tilt.
Yeah, just to jump in, one last thing that just came through. He said, quote, 50 basis point increases at coming meetings is a good base case for now. So in line with what we've heard, we're not going straight slamming on the brakes. We're tapping. We're going to tap every month here, probably for the foreseeable future.
Which again is dovish.
That's very
dovish.
I kind of thought he'd come out and say, "Hey, 1%."
Yeah, for sure. I thought he would definitely make a splash this morning and destroy the futures market, but it looks like everything is in line and nothing out of line for him this morning. So,
and I think to an extent, that's kind of what this comes down to, is we're looking at market implications of interest rates, all that. I feel like even the three of us in investment committee meetings, we've had a decent amount of disagreement in terms of, will the Fed actually take the medicine that they need to do, especially as they see markets take the brunt of that hit. And I've been skeptical. I mean, we'll see what happens, but I've kind of felt like, yeah, they're going to tap that brake as much as they can, but then at some point they're just going to let off and let this thing roll downhill. And I don't know if they have the long-term attention span and the tunnel vision that they need to just totally slowly and methodically make this work at a pace that's reasonable. I mean, you kind of have two extremes. One, this takes 18 months to get under control, and the other, they give up. And I think those are two decently likely options to an extent. Bank of America Fund Manager Survey, very, very bearish, highest cash levels we've seen since 9/11. Huge tech short positions. Ben, as we're looking at this and we're trying to figure out where we are kind of in this short-term market, how do you kind of digest that? I mean, are you surprised by any of the data point there?
I was surprised that this is the biggest tech underweight since May of 2020. That doesn't seem that long ago, but for the last 2 years, investors have been very overweight tech. And now we're the biggest underweight tech since May 2020. Having said that, we're still, we haven't seen the big outflows in equity markets that we've seen. We're not really hugely underweight equity relative to history, which typically you see at a bottom. And so what they say, their conclusion is that stocks are prone to an imminent bear market rally, but ultimate lows have not yet been reached. And I would have some sympathy with that data, with that analysis. I'd say that would probably be my base case. It's a low conviction base case, but it would probably be my base case also.
Switching gears, we talked a little bit about China. COVID transmissions in Shanghai were registered at 0 over the past 3 days. Tesla and others ramping up manufacturing. Tesla's production at Shanghai up to 45%. Chinese tech stocks rallying on that. I mean, we've talked about the COVID thing in so many different capacities. I don't know that there's a whole lot of commentary necessarily to add there, but it's certainly going to have a ripple effect, and in theory should be a positive thing for supply issues.
I think it is the causing factor for futures today that are up, and my concern is I don't know if that sticks.
Yeah, I mean, and not only does it stick, but also you wonder, just anytime you get data out of China, there's a little bit of concern. But it's been pointed out, Dow futures up 1%, S&P futures up 1.3, NASDAQ futures up 1.8. I don't think that's necessarily coming on the backs of earnings or retail sales data, all these things we're going to continue talking about on the call, but some optimism. In the world of earnings, we got earnings from Walmart, we got earnings from Home Depot, kind of a different immediate market reaction on those two. Ben, talk to us about what went on with those two companies.
Walmart missed earnings estimates pretty badly. They came in at $1.30. Estimate was $1.48. Revenue actually beat estimates. That was entirely driven by food sales. Food was up in the mid 20s. That's an acceleration from the high teens last quarter. So food really driving things. Of course, are people buying 20%, 25% more food? No, but they are spending 25% more of their budget on food because inflation is such a big deal. What we did see was general merchandise and that kind of discretionary element down in the low double digits. So that's like that 10 to 13% range. It was up last quarter, up about 2 to 3%. And now we're down 10 to 13%. Now, why are we down? A couple of reasons for that. Part is just lapping the stimulus spending from last year. So that was always going to be a little bit of a negative comp, especially as it relates to Walmart, which caters a lot more to that consumer. You also saw cooler weather, which hurt sales for apparel, patio furniture, and landscaping. But then you also have just kind of a weaker consumer. And what that's doing is that compressing margins. Walmart took $100 million more in merchandise write-downs this quarter, which sounds like a lot, but it's also in the context of $41 billion in sales. The important thing here is that over the last year and 2 years, really, they've seen historically low markdown rates. And now they're starting to see markdown rates that are actually higher than expected, which means inventory is not a problem for these guys right now. In fact, inventory may be a problem the other way. And that's beginning to be what we see. So they cut earnings estimates for the year. I think overall, this kind of mirrors what a lot of what we've been saying for the last couple of months, and that is the consumer is beginning to feel pressure from inflation. They're spending more on necessities like food because the food prices are higher, which leaves less room for making discretionary purchases at Walmart and at other places. At Home Depot, a little bit of a similar story. They executed a lot better than Walmart. Walmart's execution was really poor in the quarter. Home Depot actually had a strong top line, raised guidance for the year, but transactions are still down in the high single digit range. Tickets are up 11%. Now, the question is, and we'll know this on the call, which begins at 9 a.m., why is the ticket going up? Is it because people are buying more stuff every time they go into Home Depot? Is it because they're doing big projects, buying a lot of lumber that cost a lot more money? Or is it because they're just seeing a lot of inflation? And that's what's driving the ticket up. So that'll be the huge question. There was a slower start to spring this year. Home Depot typically gives a monthly cadence to their sales. So they'll tell us what they did in February, what they did in March, what they did in April. And we might even get some color on what they're doing so far in May. So there's going to be a huge number of questions in the conference call as it relates to what is the current trend going on for Home Depot. They did raise guidance for the year, so that's good news. But I think the stock was up 3-4% before we came in here. When the conference call goes, that'll really tell us what's going on. And so that'll go up from 9 to 10. And after that, that's when the market will digest that news.
Yeah, that'll be interesting to see. Up now, but we'll see what happens. Lots of stories in big tech. Elon Musk says he won't believe Twitter until they give more definitive evidence on fake accounts. He says, he's kind of looking at that range of at least 20%, which would be 4 times what Twitter claims. Twitter CEO says there's just not a way to really, prove any of this. At a tech conference in Miami, Musk said that fake users could possibly be as high as 90%, which seems a little bit extreme, but who knows? I think there's a big difference between fake Twitter users and inactive Twitter users, people that just consume and don't actually tweet. Twitter shares now at a 30% discount to the offer price. I think this soap opera is just going to continue, which in a lot of ways is probably exactly what Elon Musk wants.
Do you think he actually wants to buy the company, or do you think he wants to expose Twitter?
I do think he wants to buy the company. That's priority 1A in my view. I think 1B is if I don't buy the company. I think priority 1 is buy the company. Priority 2 is buy it at a cheaper price. Priority 3 is expose them in the process. That's how I would rank them. I do think he wants to own it, though.
Yep.
Michael Burry, famous investor from the Big Short era, has shorted Apple. He shorted Apple in Q1 through put options. Warren Buffett, on the other hand, has picked up $600 million of Apple stock over the last quarter. What's your takes on this? Michael Burry, obviously a very famous character that maybe gets a little too much credit moving forward post financial crisis.
This is the best trade that I've seen him make since 2000.
Yeah, he was exceptionally short treasuries in August when treasuries were at all-time lows, and then unwound that when they continued to go lower. And if he had just held on for 6 months, he would be making a ton of money. But he unwound that position right before rates really ticked up. So big loss on the balance sheet for him in terms of that trade. So he's not exactly. Sure, he's a really smart guy. He's made some unbelievable trades. He's not batting 1,000.
This is a question of timing, though, too, and just ways to make money in the markets. Burry is shorting Apple through put options, which have a definitive time shot clock on them. He saw that Apple's share price was overdone in Q1, so he basically shorted it, bet against the stock. Warren Buffett said, this is a great long-term investment. I want to own this business for 5-10 years. He bought the company. And both could be right over their respective time horizons. It's a way of making money in the market for every buyer. There's a seller.
Yeah. I think I'm probably just a hater here, but I'm hesitant to give Burry too much credit even on the Apple thing. Apple's down 18% for the year. The market's down 17%. You could have shorted a whole lot of companies and had relatively similar results over this time period. So I don't know that I'm going to totally declare victory here. Amazon has Jeff Bezos getting into a Twitter spat with the White House. This was pretty electric. Biden wants to bring down inflation, he says, by making sure the wealthiest corporations pay their fair share. that really opened up a can of worms of back and forth conversation. I can't believe I'm saying this, but I'm actually on Jeff Bezos' side.
I mean, he made some excellent points. He basically said that the companies aren't responsible for the inflation the government spending throughout COVID was the, trillions of dollars in stimulus. He called out Joe Manchin specifically saying him blocking the Build Back Better, the additional $3.5 trillion in spending, actually probably kept us from even larger inflation prints, which I think is true. I think, we talked about it on the very early calls that all this government spending was going to cause inflation. And then when the supply chain stuff kicked in, it was basically went from transitory to very, very, very sticky. And, if we had done the Build Back Better, I think we'd be in a very tough spot. Because if you think lumber prices and materials and shortages, if the government was eating up all of that with, 1/3 of the economy's amount of money and just printing that money to spend, we would have really bad inflation right now. So I think that Jeff Bezos makes some great points. I think that Elon Musk getting out there and being bolder on Twitter has kind of pushed him into a position where he feels comfortable expressing his opinions. And I think that's positive for everybody because he's telling the truth in terms of how the market works.
Yeah, I shouldn't ever be surprised by the ability of politicians to spin things, but the fact that the Democrats are now positioning themselves as the party of fiscal responsibility solely on the backs of their inability to get anything passed in the first year of Biden's presidency is wild. I mean, the spin zone, the amount of money that they set off to spend, I can remember talking with clients that were shaky and had different political leanings than the current regime last summer and kind of saying, well, even if you're of that mindset, the good news is they haven't really been able to get anything done. They haven't been able to spend nearly as much money as I thought they would be. And so if you're worried about them spending money, take some encouragement in the fact that they haven't been able to do that. I mean, they were trying everything they could to dump money into the system. And now because they couldn't pass that, they're like, well, the budget's a little better than it used to be. And so it's just a wild spin zone. We got retail sales. Anything you guys want to draw attention to that came through at 8:30 this morning?
Yeah, so we briefly touched on these right before we started the call. And there's actually been the revisions for last month have come in, which I think are actually very interesting. So retail sales month over month, the survey estimate was for 1%, and we came in just short at 0.9. Ex auto, the expectation was 0.4. We came in a little above that at 0.6. And then ex auto and gas, the expectation was 0.7, and we came in at 1%. But what I think is really interesting is they revised all of the numbers from last month up significantly. And it's not even like a small margin. So last month they said that we grew by 0.5%, and it's been revised up to 1.4. Ex auto last month, they came in at 1.1. They revised it up to 2.1. And then ex auto and gas was 0.2 last month, and they revised it up to 1.2. So those are really significant revisions. So we may have come in just a touch short month over month, but they basically added an additional 0.9 to last month, which is a really strong move. And I think it kind of plays into Ben's thought that a lot of this inflation is pushing up, retail sales growth. Some of that is going to be the fact that things are just more expensive, and that goes to the bottom line. But Ben, I'd be interested to hear your thoughts on those revisions.
Those revisions are really impressive. What you did
it's wild because then you're like, well, why should we care what the number is this month if you have that big of a magnitude of miss? Like, why would we even thematically trust what just got reported?
What's really sticks out to me on that is if you were looking at the 0.2 and 0.7, which is basically where we thought we would be before, so that's ex auto and gas, you're talking about negative real growth because you have inflation of 0.6, 0.7 a month. Now we flip to 1.2 and 1, and you're talking positive real growth in retail sales. So I think that's significant. Now the savings rate is declining, and we'll have to deal with that. But in terms of actual spending, it looks like that's actually holding up well. And it just goes to show again how bad Walmart has been. I mean, for Walmart to post US comps of 3%, even with that inflationary tailwind, that's just really bad, in my opinion, in the context of 1.2 and 1% on a month over month basis. So I think retail sales, this is a good number. Walmart just looks even worse, but it does give me a little bit more confidence on something like Target, which reports tomorrow morning.
Yeah, for sure.
Awesome. We'll wrap it up there. We'll be back tomorrow morning at 8:30. Hope you guys have a great Tuesday. Talk to you soon.